This conference will now be recorded.
Hello, everyone, and this is day 3 of our lectures on the accounting cycle. And in day 1, we looked at the first 2 steps in the accounting cycle, analyzing business transactions and making journal entries. In day 2, we looked at steps 3 and 4, posting to the ledger and preparing the trial balance. We're going to skip step 5 for now and step 6, and we're going to go on to step 7, preparing the financial statements, which is one of our main goals in the course. We're going to go to step 8, closing the accounts. So we'll be focusing on step 7 and step 8 today. Now, if you will remember, we worked on a problem and we made journal entries. We posted them to the ledger. We prepared the trial balance. And today we want to prepare the first 3 financial statements: the income statement, the statement of retained earnings, and the balance sheet. Those are the 3 statements that we're working on. So let's begin with the income statement. The income statement is the first statement that is prepared. This statement determines whether the business made a profit or loss. So it determines whether the business made a profit or a loss. Go here and correct this. To prepare the income statement, we're going to go to the trial balance and we draw a line under dividends and on top of revenues. All accounts from revenues to other expenses will appear on the income statement. We place revenues at the top, and at all revenues, we list all expenses and told them we subtract expenses from revenues to calculate the net income. So in our example in the book, we had revenues of $1 million. Our cost of goods sold, the cost of what we sold was $200, so we had a gross profit of $800,000. Our operating expenses were selling, general administrative, interest, depreciation. And so our operating income, once we subtracted these items, was $417. We had interest income of 20 that got us up to 437. We subtracted out the income taxes, and so this got us to a net income of 197,100. This is a comprehensive income statement. This is a comprehensive income statement as a guide. But let us now, and we're going to go back to our screen, and we're going to switch back to our example that we were working with and see how this works. So if you remember, we made our journal, we had these journal entries, we made the journal entries, we posted them to the ledger so we could see how much was in each account, and then we prepared a trial balance to make sure our accounts were in balance. I've added an account in here, retained earnings, because we're going to be looking at how much of the earnings we retain in the business. So we do have a new account here called retained earnings. And so I'm gonna bold that account and put it in red. When we get ready to prepare the income statement, we're gonna go down to dividends, and we're gonna put a bold line on the dividends. The income statement will simply consist of items below dividends. So when you get ready to prepare, if your trial balance is prepared and it's in order, we simply look at the items below dividends, the revenues and expenses, and we prepare the income statement. So if we go through, if we want to prepare an income statement, and we have 3 columns, we just use the one on the right. Our sales were $80,000. So we simply just bring the 80,000 here. And that's our total revenue, 80,000, as we're looking at a very simple example. Then we're going to go and pick up our expenses. We only had one expense, rent. If we had others, we'd add them up together, but we put the rent here. And so our total expenses are 3,000. We subtract total expense from total revenue, and so our net income is 77,000. That is all that is involved in preparing the income statement. We simply go to the trial balance, we draw our line under dividends, a bold black line, then everything from sales down to all expenses go on the income statement, and we have determined in this problem that we made a net income of 77,000. The next question would be, how much of this income did we retain in the business? And so we're going to prepare a statement of retained earnings. That is a simple statement to prepare. And remember, it's a new company, so we didn't have any beginning earnings in the business. So we can put a 0 here, and this is typically how our problems will work. Now, we add net income. So we go ahead and get the net income, 77,000, and we put it in here. Then we're going to subtract out, I guess my numbers have gotten smaller here. Let me just put these out of 14. Okay, and we'll stay at 14. Then we're going to subtract dividends, and we go to the trial balance. Our dividends were $2,000. And so we put the $2,000 here. Going back to. And so we subtract the 2,000 from the 77,000. And that tells us that we retain $75,000. Okay, so let's look at where we are. We made 77,000. Okay. We've paid out dividends to the owners of 2,000. So the ending retained earnings, the amount of the net income that we retained in the business is $75,000. So the purpose of the statement of retained earnings is simply to show what are our beginning retained earnings, zero in this case, what was our net income less the dividends. So this gives us the ending retained earnings. So this is how the statement looks. It's beginning retained earnings, add dividends, add net income less dividends in the retained earnings. If you had a loss, you would subtract the loss. Okay, let's go back and change in the screen again. We're going to go back to the primer. So this is how the income statement looks. This is that formula for the retained earnings. And retained earnings statements are going to look like this: retained earnings plus net income less dividends, ending retained earnings. So if we had a beginning retained earnings, we subtract out the net income, added the net income to it, we would subtract out dividends. This would give us the ending retained earnings. So these are the four lines that are on a state of any statement of retained earnings. The balance sheet will reflect this number. The balance sheet is going to reflect the ending retained earnings. And as we said before, this statement is on a cumulative basis. It's going to tell us the amount of earnings that we retained in the business. The third statement that we prepare, okay, so we prepared an income statement, how much income we made. We prepared a statement of retained earnings, how much of this income that we retained in the business. The final statement we prepare is a balance sheet, and everybody has a balance sheet. You have a balance sheet. The balance sheet embodies the accounting equation, assets equal liabilities plus stockholders' equity. And so this statement is telling us what are the total assets at a particular point in time, December 31st? What are the total liabilities? And what's the total stockholders' equity? So we use these three statements to look at how the business is doing. We don't look at the journal entries, the posting to the ledger, the trial balance. We must make our determinations from these three statements. And when we go back to that example, we're going to say that we're going to draw a line on the trial balance below retained earnings and above dividends. All accounts from cash to retained earnings will appear on the balance sheet. The balance sheet shows the current balances in all what's called the permanent accounts. So we'll get back to this a little bit later, but it shows the balances in the permanent accounts. When prepared correctly, total assets will equal total liabilities plus stockholders' equity, because that statement reflects this equation: assets equal liabilities plus stockholders' equity. So let's look at a balance sheet. Teddy Fab Inc. It has its current assets, cash, receivables, inventory, total current assets. It has its property, plant, and equipment. It has its other assets, total assets, 472,100. So this is an example of how a comprehensive balance sheet looks. We won't work with one this comprehensive in this chapter, but this shows what it looks like. Liabilities, we add them together. It had total current liabilities of 47. They had a long-term debt, so their total liabilities were 247. Common stock, additional paid in capital, that paid in retained earnings. Treasury stock is stock that you purchased back that you originally issued, so you subtract that. So the total liabilities and stocks, total liabilities and shareholders' equity, 472,100. So these must equal the assets must equal the liabilities plus stockholders' equity. And so you're going to total these and make sure you're here. And we're going to get into the preparation of a balance sheet, from our example before, but let's look at the functions of the financial statement. The balance sheet, beginning balance sheet, tells us where we are. The income statement tells us what happened. A statement of retained earnings would tell us how much of the income we retained in the business, and a statement of cash flow, which we prepare later, tells us how much, what do we do with the cash? Where did the cash come from? Where did it go? And then the ending balance sheet, this balance sheet here, tells us where we are. So where did we start? What happened? And where do we end? Statement of retained earnings should be in here, but this example that we're using, didn't put it in. And of course, on a picture, you can't add anything to it. And of course, in our next class period, you all will be working this problem for me. You'll be working this problem all the way through. Okay, so let's go back to our screen and go back to our example that we were looking at before. So of course, this is the example that we're looking at before. Here's that trial balance. So when we get ready to prepare the statement of retained earnings, the balance sheet, we're going to have a underline here. And everything from retained earnings up goes on the balance sheet. Dividends down goes on the income statement. Retained earnings up goes on the balance sheet. So you can see the importance of this trial balance. If you have it in this order, and if you're in balance, then it's just a real simple thing. Do the income statement, utilizing these accounts below. Then we do the statement of retained earnings, beginning retained earnings. We add the net income, less the dividends to get us to ending retained earnings. So now we want to look at, okay, our third statement in terms of where do we stand now in terms of the accounting equation, assets equal liabilities plus stockholders' equity. So we go up to our trial balance, and we're going to pull down our three accounts for assets that we have. We're going to copy these. And we're going to paste them here. Okay. So we have cash, receivables, and supplies. Our dollar amounts in those accounts are 94, 10, and 9. So I'm going to copy these. And I'll just put those here on end of the year. And then if we add the 94, the 10, and the 9, we'll find that our total assets are $113,000. That's all it takes to prepare a balance sheet. We don't have any long-term assets, so our total assets are $113,000. So hopefully you realize if you got a trial balance, we're going to go to the top of that trial balance, and I guess I left the space here. So with the spacing here, everything above the space is going to go on the asset side of the trial balance. So everything above the space, I left a space. So you might want to do this. Once you finish all your assets, put that space in there, and you know everything above this. We didn't have any long-term assets, but if they were there, and we'll get to that, you know, they would come down here, total assets. So in preparing your trial balance, leave a space for the assets. Okay, leave a space, and then the, you know, everything from the assets on up will go on the left side of the balance sheet, or the top of the balance sheet. Then for the bottom of the balance sheet, we're going to pick up our liabilities. So I'm going to go in here. We have accounts payable and notes payable. I'm going to copy those. I'm going to go to my current liabilities. I'm just going to paste them right there. Accounts payable, short-term notes payable. The amounts were $3,000 and $5,000. I'm going to copy these. Coming out, just put these here. And so our total current liabilities are $28,000. In our simple example here, we don't have any long-term liabilities, so the total liabilities are $28,000. Our common stock, which is the next item on here, is $10,000. So we take the common stock for $10,000 and we put it here, $10,000. Now the retained earnings on the trial balance is 0, because this is the beginning retained earnings. But having prepared that statement of retained earnings, we know that the retained earnings at the end of the period is $75,000. And so we're going to put the $75,000 here for retained earnings. So we move the ending retained earnings to the balance sheet. And so our total equity is now $85,000. And our total liabilities and equity is going to be 28 plus 85. And if I've added that's correct, it's 113,000. And they balance the assets and the liabilities and equity balance. So for those 10 transactions, they resulted in us, first of all, making net income of $77,000. This is all, you know, you're going to see for the business. You don't see anything prior to this. So if you look at this company, they made $77,000. They retained $75,000 in the business. They paid $2,000 out the dividends. And the way their balance sheet looks at the end of this first year, they have cash of $94,000, receivables $10,000, supplies of $9,000, total current assets $113,000, and total assets $113,000. Their liabilities are $28,000. Their common stock is $10,000. They retain $75,000 in the business. So their total equity now is $85,000, and they have $113,000. So remember, we said when we look at a business, we want to look at what its beginning cash was and we started this business of $10,000, and we want that cash to go up. So when we look at the balance sheet, we see that the cash is now 94,000. So we've done very well. We want the cash to go up, and we want a lot of that increase to be from earnings. And we want it generated by earnings. Now, some of it was created because we borrowed money. So you look at that. Okay, what are my assets? What's my cash? What are my liabilities? And we look like we're in pretty good shape. Okay, we have one other thing that we want to look at today. And we're going to go back to the primer and look at closing entries. We can get closing entries in here. Journalizing and posting closing entries. Closing entries are entries that we make at the end of the period. There are two fundamental types of accounts in accounting: permanent accounts and temporary accounts. Assets, liabilities, and stockholders' equity are permanent accounts. All the other accounts are temporary accounts. So let's just see if we can. Okay, I found the chart of accounts. On our chart of accounts, the balance sheet accounts, all the accounts over here through 4/5 retained earnings are permanent accounts. So every account through 4/5 are permanent. Every account from dividends on down, dividends, income summary, and all the revenue accounts are temporary accounts. Permanent accounts all the way through retained earnings. Temporary accounts, revenues, expenses, and dividends, and income summary. Okay, so the permanent accounts are going to track activities, and they're going to go beyond the current period. So they're going to stay there. They're housed on the balance sheet. Permanent accounts include assets, such as cash, equipment, notes payable. The permanent accounts that I just showed you. Temporary accounts, on the other hand, are used to record accounting activity, consistent of revenues and expenses, dividends for a specific period, a year. All the revenue and expense accounts and dividends must end with a zero balance because they're not utilized in the next year. If you think about your student account, after you pay your bill, you want it to be zero. You want it closed out. That's called close the account out. When you do your tax return, when you did your tax return for 2019, you used the 2019 income. when you do 2020, you're going to use the income that you earned in 2020. So when you close out, eliminate your 2019 amounts. And so that's what a business does. So as part of the closing process, the net income will be moved to retained earnings, and the dividends will also be closed to retained earnings. We do not like a lot of activity in the retained earnings account. We only want to see two things: revenues, hopefully net income, or net loss and dividends. And so we use an income summary account, and we'll look at this. It's sort of an intermediate account to close out the revenues and expenses, because we might have 1,000 and we don't want all of that into retained earnings. Income summary is a holding account. It's going to aggregate all the income and expenses, and it's going to tell us how much that we need to close to retain earnings, and it's going to end with a zero balance. So the income summary collects the net income for the period, distributes the amount to retain earnings. After the closing entries are made, and then always with a journal entries, they're posted to the ledger. So the balance from the temporary accounts are shifted to the income summary first, so that got a better audit trail. The use of closing entries is going to reset the temporary accounts to begin accumulating new transactions the next period. And the closing entries also are going to create an amount in retained earnings. Remember, the retained earnings is zero, and so it can only get an amount utilized in closing entries. There are 4 closing entries. We debit all the revenue accounts and credit income summary, thereby clearing out the balances in the revenue accounts. We credit all expense accounts and debit income summary, thereby clearing out all the balances in those accounts. And then we close the income summary account to the retained earnings account. If there was a profit in the period, then this entry is a debit to income summary and a credit to retained earnings. If there was a loss in the period, then this entry is a credit to income summary and a debit to retained earnings. So let's summarize the 4 closing entries. Closing entry 1, we debit revenue and credit income summary. We close all the revenue accounts. Closing entry 2, we're going to debit income summary and credit expenses. We close all the expense accounts. Closing entry 3, if there's income, we debit income summary and credit retained earnings. If there's a loss, we're going to debit retained earnings and credit income summary. We'll mainly be working with this first scenario, the income, most of the time. And then closing entry 4, we debit retained earnings and we credit dividends to close that out. So these are the 4 closing entries that we make at the end of the period. And once we post them to the ledger, we get an amount in retained earnings, and those accounts go to zero. Let's look at a simple example. We have a trial balance of cash, receivables, supplies, equipment, accumulated depreciation, accounts payable, notes payable, common stock, and retained earnings. Beginning retained earnings. All of these accounts are permanent accounts. So I'll just bold all of these. These are the permanent accounts. They're going to stay. At some point in time, these are all temporary accounts, and I'm going to put a strike in there. We're going to close them out. And we're going to close out their balances. And so there'll be zero, and then retained earnings will be at a different amount. So retained earnings, these are all temporary retained earnings account, and we're going to reflect them in the retained earnings eventually. So let's do an income statement. We're going to start here at sales, 700,000, cost of goods sold, 300, gross profit, rent, total expenses, 100, net income, 300,000. Then we're going to do our statement of retained earnings. Beginning retained earnings 15 plus the net income less the dividends gives us an ending retained earnings of 305. So eventually we want the retained earnings to be 305. This is going to be the new retained earnings. And we're going to get that because we're going to eliminate the balances in all of these accounts. Okay, so we eliminate all the balance in these accounts. Let's not forget dividends. Strike it. Because these are temporary retained earnings accounts that we utilize so we can prepare these statements. But then once we get this in retained earnings of 305, we don't need these accounts anymore for this year. They got to be closed to zero so they can come back to be utilized the next year. Okay. And so when we do the balance sheet now, let's look at this balance sheet. These accounts, 100, 520, 345, they come right in to get up and accumulate appreciation. It's a contra asset account as a credit balance. You give us these total assets of 435. Then we're going to put our liabilities over here, permanent accounts, 10 and 20 in the common stock, and the new retained earnings, not the old one, but the new one. And so we are in balance. Now, for this to occur, we're going to make our closing entries. Closing entry 1. We're going to debit the revenue account because if it has a credit balance, we debit it to close it out. So we debit revenue for 700,000. We credit income summary for 700,000. That's the first closing entry. The second closing entry, we got to close out the cost of goods sold and rent. So we're going to debit income summary for 400,000, credit cost of goods sold and rent expense for 300 and 100. And so now our income summary account has a balance of 300,000. So we're going to debit income summary in the third closing entry and credit retained earnings for 300,000. The amount in closing entry 3 is always the net income. The amount in closing entry 3 is always the net income. And for the third time, the amount in closing entry 3 is always the net income. Closing entry 4, we're going to close out the dividends. So we're going to debit retained earnings and credit dividends. And so when we make those entries and we post them to the T accounts, then the retained earnings would then have a balance of 305. And we'll look at that in our example. We have our final step in the process, which is our post-closing trial balance, but we just make sure we're in balance. And so we simply have the permanent accounts, the same accounts that are on the balance sheet. So if we were doing with this example here, if we were doing a post-closing trial balance, we simply just list these accounts and make sure we're in balance. It is simply a balance sheet, but we would have, we would have the 35 here. So we won't worry about it that much, except for, that in a post-closing trial balance, we just make sure all of the accounts are in balance, and we're still in balance. It's the balance sheet accounts except for the appreciation, things like that. They're going to be on the credit side. And we're going to balance out. So not a major thing. Post-closing trial balance. It's kind of synonymous with the balance sheet, except we're going to list the accounts separately. Okay, so let's go back. At this point, and we're going to go back to our illustration that we were working with. And we had prepared the statement of retained earnings and the income statement, statement of retained earnings, and the balance sheet. And now we want to make the closing entries. Okay. So what's our first closing entry going to be? We're going to go up here and close out the sales. So I'm going to go through here and put a strike in. And I'm going to debit sales. And I'm going to credit income summary. And this is just a holding account that we're utilizing. And this is closing entry 1. So I'm just going to put Roman numeral 1 here. So we aren't so much work, about the accounts, but well, so that we don't get confused, let us go ahead and put the accounts in. So sales is 500. So let's just go ahead and put the 500 here. And income summary. I'll add it later in the account number. But we're going to credit the income summary for the amount of the sales, which is 80,000. And let's just see here. Let me do an insert. Row above. And I'm just going to put this in 16. I'm going to center. And I'm going to put a 1 here. So we got closing entry 1. Then I'm going to take closing entry 1. And I'm going to go to the T account. And I'm going to post it. So when I post it, This account now is zeroed out and it's going to have a zero balance. So once I posted it, it's zeroed out. And I'm going to take my income summary account. I'm going to put it here. And the income summary now has a credit from that journal entry of 80,000. So once we make the closing entry, we have to come back and post it. Now let's go to closing entry 2. And in closing entry 2, we're going to debit income summary now. And we're going to credit rent expense. It's the only expense we have. And of course, the amount of our rent expense was $3,000. So once we've done that now, we scratch out the rent expense is gone, and now we're going to come over here and post it. So we're going to put 3,000 here. The rent expense is now closed out. And we're going to debit income summary now for the 3,000. Okay. In our third closing entry, we said what? So in closing entry 3, we're going to, assuming we have income, we will now debit income summary. And we're going to credit retained earnings. So we debit the income summary and we credit and retain earnings. What amount? The net income, 77,000.
This conference will now be recorded.
Okay, so we want to now, let's go and post this journal entry. Let's remember retained earnings has a zero balance. And so we're going to debit the income summary, and we're going to credit retained earnings. Let's just put retained earnings here. So we will have a credit in the retained earnings account for $77,000. And when we post these entries in the income summary, 80,000, 000, and the totals 80,000, 000, it balances it out. So this account is served its purpose to clear out revenues and expenses. And so we can now scratch it out. It has a zero balance. And of course, the rent is gone. And we got one closing entry left to make. Closing entry number 4. And this is the closing out of the dividends. So it goes to the trial balance. And the dividends has a $2,000 balance. And so we're going to scratch it. And then with this 2,000, we'll make our final closing entry 4. And these closing entries stay the same, where we're going to debit retained earnings. And we're going to credit dividends. And so once we've done that, our amount in the trial balance is $2,000. So we debit retained earnings for $2,000, and we credit dividends for $2,000. Then we're going to post this to the T account. So we then come to dividends, and we credit dividends for $2,000. Dividend is now closed out. So it will begin the next year new. And we're going to debit retained earnings for $2,000. And this will give us a balance in the retained earnings account of $75,000. So you can see once the closing entries are made, Once they're made, we then are able to get the balances. We get a balance for the retained earnings account. And the temporary accounts are closed out. What does the closing do? For your fee for fall of 2021, you don't want any of your last year 2019, 2020 numbers in there. And so your account was closed out. It starts anew. The same thing occurs with a business. It utilizes the account's income summary, dividends, and on, all of these accounts. Prepare statements, then close them out so they can, for 2021, do the same thing again. We're going to close it out. 2022, same thing. We accumulate the data for that year and we close it out. So the accounts from income summary, dividends, all revenues and expenses are temporary accounts. They're closed out. And once the closing entries are made, instead of retained earnings having a zero balance, it now has the appropriate $75,000 balance, which is what we see on the balance sheet. So we have covered a lot. In these 3 sessions. But they are the basics of accounting. So let's go back and review briefly. You've got to have a mindset that you're going to start a business and make money. And once you do that, you will start a company, you put your money in, and you get a stock certificate. And the goal of accounting is to prepare 4 financial statements. We're only working with 3 now: the income statement, the statement of retained earnings, and the balance sheet. We have our equation: assets equal liabilities plus stockholders' equity, asset, which is common stock plus retained earnings. And retained earnings consist of revenues and expenses and dividends. These are temporary retained earnings accounts. We talked about the double entry system. When there's a transaction between individuals, you receive something of value, you debit. You give up something of value, you credit. Then we move into the accounting cycle. Step 1, we analyze transaction, made journal entries. Step 2, we post it to the ledger.
This conference will now be recorded.
So after we made our analyzed transaction, made our journal entries, we post it to the ledger. Then we prepared the trial balance. We skipped step 5 and 6 and went on to prepare the financial statements. And then we closed the accounts, and we talked briefly about the post-closing trial balance. We learned a process for analyzing transactions where we said that there were 20 journal entries, and we're looking at roughly 8 or 9 of those. So we have this chart. Whenever we make a journal entry, when cash comes in, we debit cash, and the chart tells us what the credit. So we just have to determine what type of transaction it is. When cash goes out, we credit cash, and we simply determine what type of transaction it is and make a determination of what's going to be debited. And then we only looked at journal entry 12, which is non-cash purchase of assets utilizing debt, and journal entry 15, sales on account. We had a chart of accounts, so any journal entry has to have 2 accounts at least. They're balance sheet accounts, which are permanent accounts, going down to retained earnings. Then we have the temporary accounts that start at dividends, income summary, and goes all the way down on this right side. These are the accounts that we use in the course. We don't create any other accounts. When we make a journal entry, we select the account and we select the account number so that we got a specific account. Just like your bank account, you got a number, we have to make sure it goes in that account. And notice that for income summary, that number was 475. That's the account number that we'll be using in the journal entries. So we had our example that we looked at, and then we posted to the ledger, and we talked about that. We prepared the trial balance. This is the foundation. Make the journal entries, post to the ledger. Once we have a trial balance, we simply look on the retained earnings, no dividends here. Everything from here down would go on the income statement. Everything from retained earnings would go up from the balance sheet. So you should be able to look at this and prepare an income statement and a balance sheet. This is how a little comprehensive income statement looks. This is how a statement of retained earnings looks, which shows how much is retained in the business. And it looks this way all the time, except you would subtract if there was a net loss. This is the balance sheet, which shows where we are at a particular point in time. So once we had the income, this shows all the assets, property, plant, and equipment, all the liabilities, all the stockholders' equity, the permanent accounts. Income statement, temporary accounts with dividends. The balance sheet has the permanent accounts. The balance sheet at the beginning of the period tells us where we are. We were new company, 0. Income tells us what happened, how much income we made. The cash flow statement, when we prepare it, will tell us what happened with the cash. The statement of retained earnings tells us how much of the earnings were retained in the business, and we get to the ending balance sheet. And we will be working this journal entry practice problem, a little more comprehensive at the next class period. So you should go ahead and be working this problem out. Have all of this ready for me next class period. Then we talked about closing entries, where we have 4 closing entries. We close out the revenue, we close out the expenses, we close out the net income, and we close out the retained earnings. When the closing entries are completed and posting, retained earnings has the balance in it at the end of the year, and all of the temporary accounts are now closed out to 0. And finally, we talked about the fact that we prepare a post-closing trial balance to make sure the accounts are in order, make sure there are no errors after posting, and we would just list each account so it would not be in balance sheet format, but each account is listed, and we want to make sure that we're in balance at the end of the period. So you know, we've now covered the basics of accounting. We will simply build on this for the rest of this course and even for the second course in accounting. We build on these fundamentals that we've covered in this first month of the chapter. So I know we've enjoyed this. We learned this. We have to. Everything is about money. I don't care what business you're in. And so that's why so many majors require it. This is why this is virtually the first course in accounting. This is the starting point and the most important part of business, the money. Thank you.